Hi, I'm Mike Ward. I want to talk to you about the metrics that we use, or at least the important metrics that we ought to use when we measure corporate performance. Now, when I ask people, what is the purpose of business? They generally come up with one answer: to make money, or perhaps in a more financial way, to make profit. And that's a good start, but it's not nearly enough. Let me demonstrate the problem. If we've got two companies, here I've got company A and company B, and you can see very different financial statements, and here we're focusing on their income statement. The first question we need to ask is, well, which profit do we look at? Should we look at the gross profit, the operating profit, in other words, before interest and tax, or the net profit after we've paid everything? Well, most people like to focus on the bottom line, which makes sense, because in the same way that when you look at your paycheck, you like to go and see not so much what you started with, but after all deductions, what's left. That's a good place to start. But here you can see company B, which is much bigger, twice the revenue, has in fact got much more profit. Does that make it better? Of course not. We can't simply look at profit. Just because a company makes profit doesn't tell us how much has been invested in that company. And to do that, we have to look at the balance sheet. And so if I were to tell you, for example, that these are the assets in company A's balance sheet, and these are funded by shareholder money, and here's company B, notice again, it's twice as big. So we might anticipate then that it should be making twice as much profit, but it isn't. So which one is doing better? Well, to get to the bottom of this, we have to look at some ratios. And here I'm showing you some ratios. People like often to focus on the profit margin. And if you look at the profit margin here, you'll see company A is making 25,000 out of revenue of 100,000. That means it's got a 25% profit margin. What about B? Well, B is only making 45,000 on double the revenue. So that is only 22.5%. But is that the only thing? Well, not at all. If we look at more important measures of performance, such as not just what happened on the income statement here, but what happened on the balance sheet as well, what was the return on investment? And here you can start to see, if we look at this from what we call an operating performance, from the position of operating managers who work with the company, and before we knock off what is owed to the bank and to the receiver of revenue, well, you can see 40,000 on assets of 100,000 is a 40% return on assets. That's pretty good. For company B, though, we've got twice as much profit and twice as much assets. So it's also coming in at 40%. But maybe a better way of looking at this is from a shareholder perspective. Shareholders are interested in what profit is left to them after they have paid everything, including financial costs for loans and so on. And here you can see this company, A, has made 25,000, and how much did shareholders put in? 100,000. So their return on equity is 25%. But what about company B? A lot of people would worry about the fact that company B, although it's twice the size, has taken on a lot of debt to fund this. It's 50% funded by debt. Shouldn't we be worried about debt? Well, we should be, but actually it is more risky, but there are twice as many assets in this company. So it's not like there's nothing to show for this debt. And what's more than that, if you knock off the costs of debt, as we've correctly done here in company B, you can see that our profit is 45,000. Who does this belong to? Well, we've paid for the debt. So 45,000 on an investment by shareholders of 100,000 is a 45% return to shareholders. So in finance, we like to argue that that is the number one metric that one wants to look at. Now, usually people start off by saying, we want to maximize profit, but pretty soon it's easy to convince them that you need to look at the balance sheet as well, and look at the return on net assets. And this is looking at it from the perspective of operating managers, as I said just now. But shareholders, who are the ones who actually give the capital up front for the company, are very interested in what return they're going to get. And they focus on return on equity. We didn't even talk about the dividend, which is sometimes an issue. People think that dividends are important, and of course they are. But on the whole, well, in fact, those dividends, of course, belong to those shareholders anyway. And what the company doesn't pay out also belongs to them in the form of retained earnings. So dividends also incur taxes. Not all shareholders want dividends in the first place. So this is a safer place to start. But this is accounting data. When you look at return on equity, you need the financial statements. You need to know what the profit was and what the investment in assets was over many years. And it's therefore a backward-looking ratio. So mostly we also look to see what's been happening with share prices. Of course, all companies have a share price, but not all are listed. And so you can't always see the share price. So we're not so interested in the share price itself, I might add. We're interested, though, in the returns that shareholders have had or might have got over a preceding year or maybe 5 years or something like that. Now, you will find that, in fact, ROE, which is an accounting measure looking backwards, and share price performance, return on shares, are, in fact, highly correlated. The two work together. Not always, though. Sometimes you can produce very good ROE, but the share price tanks. And that's because the share price is looking to the future. And maybe something in the future is reflecting a difference from what happened in the past. So we need to kind of bear in mind both of those numbers. Now I want to come back and focus a little more on how we get to these metrics and what they actually mean. So shareholders, though, and this is why we plug for them, are what we refer to as residual claimants. They take the greatest risk. All other stakeholders are paid before them, whether it's the bank or their employees or the taxman, suppliers, everybody is paid before them. They are the only group of stakeholders to need the full details of all other claims by all other stakeholders. They get what's left. And many times, even though there's a profit, it isn't a sufficient profit to give them a decent return. So we've got to be very careful about focusing on profit. Another way of thinking about this, why should we value shareholders, why value, if you like, is because, well, if you don't look after share prices, and they are fundamentally driven by long-term planning and good management, if the share price starts to fall, well, what happens? The shareholders, to begin with, just sell their shares. The share price therefore falls. Well, that has consequences. As the share price keeps falling, it becomes very difficult for a company to attract new capital if it needs it. It'll be expensive. It invites what we call hostile takeovers. Other shareholders, other companies, private equity companies, and others are going to come along and buy out that company, sometimes at a cheap price. These companies require what we euphemistically refer to as operational restructuring or right sizing. You've heard these terms, I'm sure. And what does that really mean? Well, it means we've got to actually cut costs, which usually means retrench people. We've got to sell off non-performing assets and so on. That's a very difficult process. And if that doesn't work, well, then we get to the stage where the assets are in fact worth more than the company's worth. And so the best thing you can do is close down the company and sell all the assets. We call that asset stripping. Now, that's not what we're trying to do in finance. We're trying to create jobs. And to do that, we must give returns to the investors who put their money into companies, shareholders. So just to give you a sense of this, if you were to ask Goldman Sachs, what is their key ratio? And they're quick to tell you this, in fact, it's return on equity. What are shareholders getting in an accounting sense? If you look at how well has Goldman Sachs actually done, and you can see this is some of their latest data over here, they set themselves a target range of around 15% per annum. That is obviously in dollars, and that's not a bad return on equity for shareholders. They haven't achieved that for many years now. In fact, they've just come back into double digits, but that's what they're aiming for. It's a good metric. Now, let's backstep a little bit. if we're looking at this from an operating perspective within the company, companies often use this measure here, return on net assets. And the calculation, as we saw earlier, is to take the operating profit, earnings before interest and tax, because they argue that most operating managers are not really responsible for the interest paid or the tax paid. Take that number and divide it by the net assets that are in the company. Now, if we do a little bit of algebra on that, we can multiply this by sales over sales, and we can rearrange this. We get, in fact, two components which together make up RONA. Now, I know that some people have problems when we expand things rather than reduce these equations, especially engineers, but this is helpful because it in fact gives us an insight into the two main levers that drive RONA. If we can get this number up and this number up, multiply them together, we're going to get a better RONA. Now, this ratio here, you may recognize, its correct name is the operating profit margin. What is the profitability of the company? This one here is a little more tricky. It's a measure of efficiency. Its correct technical name is the net asset turnover ratio, but most people don't really understand that. And we prefer to think of it as a measure of sweating assets, if you prefer, or efficiency in asset utilization. Now, there are three things that enable you to improve your profit margin. First of all, pricing. Now, I need to quickly say that these three things are also all connected to the volume that's sold, the number of units you sell. So it's not always a case of putting up your price that's going to improve your profit margin, because maybe the volume you sell is going to drop by more than the increase that you put up in your price. So I rather say pricing. Sometimes it pays to put down your price in a price-sensitive industry, and if you put down your price by 5%, maybe your volume will grow up by, say, 10%. Then you're going to do better. So the first thing we want to focus on then is pricing. But the second thing, which is also connected to volume, is if you cut your expenses. Normally we say cut, but again it relates to the volume. So if you increase, for example, your marketing spend, and in fact the volume goes up by more than your increase in marketing spend, well, that's good. So again, I don't want to say cut expenses, but I do want to say looking at your costs and your expenses is the second component of what improves your profit margin. But there's a third thing as well, the product mix. Some items in your store or your business, your company, are going to make more profit for the effort or the assets that you put into them. And one wants to therefore focus on the high profit margin items. That can improve your profit margin overall. So three things to think about: pricing, expenses, and product mix. They all affect this one important lever in the business. But that's not the only thing. Most people are very familiar with improving profit margin. They never think about this. If you are able to run the business more efficiently, in other words, on fewer assets, you're going to need less net assets. And if you can reduce this part of the equation, well, that's also good. So one needs to be thinking carefully, and there are three things to think about here. Are you fully utilizing the assets, those trucks, those cars, those workshops, those warehouses, machines, whatever? Are they running at their full capacity? The second thing is, are you running those assets 24/7, 365 days a year? Are you utilizing them all the time? If the shop is closed for a portion of time, well, maybe one thing to think about is to open it for longer hours, that type of thing. Of course, it doesn't always work. But there's a third thing as well. If you're able to operate more efficiently in terms of being faster at what you do, if you can make those widgets faster, if you can get stuff through the shop quicker, if your trucks can deliver more quickly, well, that's another way of saving on assets. So it's just important to focus on the efficiency of the business as it is on the profit margin. These two things work together. So in your heads, it's useful to think of these levers that management have to control. And just now, I'm going to introduce you to a third one, which is important for shareholders. Now, just to reiterate, You can have a business which has got a RONA of 20% and its profit margin may be very low, 1%, but it sweats its assets a lot. This could, for example, be a low-cost airline where those planes fly in and fly out all the time. They turn them around straight away. They get the passengers in and out very quickly. They make sure that the seats are full and they have a very low profit margin. 1% times 20% gives you a RONA of 20%. Similarly, though, you could be much less efficient. You could have a similar business, a high-cost airline now, where there's more frills, more options available, and you're going to charge more for it with a higher profit margin, but you're going to be less efficient. Maybe to offer those services, you're going to have some spare seats from time to time. You're not going to be able to fly those planes as quickly or as efficiently, and so you still end up with a 20% profit margin. Many times, though, you find that these companies aren't able, given the competition here, though, to keep these margins. So it can be a problem over time. But let's turn now to some of the metrics that people use. All of these metrics I'm showing you here, ROE, RONA, the profit margin, the gross profit margin, and so on, are measures. These are just subsets of that first ratio, the profit margin. Similarly, there are many activity ratios which measure efficiency. You can look at your net asset turnover. How many times do you sell, if you like, in effect, your assets in the business? What about working capital ratios like inventory days or receivable days? You'll hear these terms often. These are all members of the second set of ratios that we need to look at. Now, coming back to shareholders again, not operating managers this time, we want to change what we've been looking at. We want to this time not use operating profit as the numerator in our equation, but what shareholders are interested in, which is the net income after interest and after tax. And we're going to divide this not by net assets, but by what the shareholders have put in, equity. Then we can do our trick with the algebra here. We're going to multiply this by sales over sales and net assets over net assets. So we're going to rearrange this. People hate this sometimes because it's true. This cancels with that cancels with that, and we're back to where we started with. But it helps us to understand what's going on within the ratios. Now you will recognize the first one. It's changed slightly in that this time we're looking at the net profit margin, not the operating profit margin that we were looking at earlier. But nevertheless, there are three things that drive it: the costs, the pricing, and the product mix. This is exactly the same ratio we saw before, which measures efficiency. Three things which drive it: how fully utilized we are in our factories or in our operations, whether we work them 24/7, 365, and whether we are able to do things faster. All drive efficiency. But now you will notice we've introduced a third ratio, which is a measure of what we call gearing. Doesn't look like it. Very often when people measure gearing or leverage, as the Americans call it, they use debt divided by equity. But net assets is just the sum of debt plus equity. So it is a measure of gearing. It's 1 plus the debt to equity ratio, actually. So it's a measure of who put the money in. And as I showed you earlier, putting money in, letting the bank put in money is a very good way of gearing up your return if you're a shareholder. And it's important for most companies to think about doing that. So we can improve our returns to shareholders with debt. Now, of course, we need then to look at some of the ratios that relate to gearing. And these are the things banks like to focus on here, the debt to equity ratio, as I mentioned just now. But this is a very important one as well, called the interest cover ratio here, where we take our operating profit, earnings before interest and tax, divided by the amount of interest we pay. And for a bank, they want this number to be about 5 times. So they want to show big profits before they're going to give you, to determine how much interest they're going to let you actually pay. If you want to be AAA rated in your rating, this ratio is going to be 10 or 15 times. That really means you've got very little debt. But debt can be helpful because it moves a lot of the power to the return on equity, as we saw. Now, this is a really important slide that I want to take you through here. I'm putting up here our little formula that we've said here. the return on equity can be broken down into the profit margin, the efficiency, and financial leverage. And I've started by saying, across these 7 different industries that I'm showing you here, I would like the return on equity to be 20%. That's just seemed like a good starting point. Now, what I'm showing you here is that, and you can take out your calculator and check these things if you want to, 7% times 2.5 times 1.1 gives you approximately 20%. And so does 8 times 2.5 times 1, also gives you 20%. All of these combinations here, it's just maths, are going to give you a 20% return on equity. But these companies are very different. Take this one, for example. A typical retailer will have very low profit margins, 1.3%, but it will be able to sweat its assets 10 times. What this ratio really means are its sales are 10 times the value of its net assets. That's extremely efficient. And there'll be a moderate amount of debt in a retailer. I've got it at 1.5 times here. That is what we call our equity multiplier ratio, the one I showed you just now. But compare these numbers to, for example, a paper and packaging company, where you'll find much higher profit margins, 20%. They're much less efficient. Why is that? Because they need to have a lot of assets. If you want to make paper, you need trees, you need land, you need big machines, trucks to bring those things to the mill and so on. So they're very asset intensive. So they tend to be very inefficient. They can't sweat their assets nearly as much as a retailer. And they have more debt. That's partly because they need it, but also because, in fact, they need it to fund their assets, but they also need more debt, and banks will lend them more debt simply to get their ratios up to the levels that they should be. Now, in one sense, investors don't really care which industry they put their money into. They want to see returns. And so you're going to find retailers don't just compete amongst themselves, they're also competing for shareholder capital with every other industry that's out there. You cannot run a forestry company, a paper and packaging company, like you can a retailer. So these sets of ratios that I'm illustrating here are very different for different industries. They will always be. And the reasons why this happens is, if you focus, for example, on retailing, is because retailing happens to be a very competitive industry. There are always many retailers. That's because the barriers to entry in that industry are very low. You don't need much. You can rent your premises. You can get your suppliers to put up stock. You put in some tills. I'm exaggerating a bit, but you're pretty much in business. But here, if you want to be a forestry company and make paper, you need lots of assets, lots of time. That's expensive. So those high barriers to entry, which in this instance for paper and pulp and packaging companies are going to be capital expenditure, that's the barrier to entry. There can be many others, technology, for example, patents, those kinds of things, protection from the government, monopolies, licenses, all these kinds of things give you what we call margin. You can be a high margin business, and you need to be, because you're probably going to have to invest a lot in the form of assets. So where there are barriers to entry, you're going to find companies will have high margins, but where there aren't, you're going to find there's much more competition, but nevertheless, they've got to therefore be much more efficient here. And the net result is that they must deliver high returns. So ROE is a nice metric because it standardizes everything. You can compare at this level different industries, which you cannot really do with RONA or profit margins or efficiency. They're going to be different. They have to be. But this is a standardized measure. So it's great. Now, just to illustrate, here is a retailer. And you can see here, just track you back over time here, that their return on equity had once 10 years ago was very high, 67 and a bit % here, and it's declined. And if we unpack the things that have declined over time, you will notice, for example, here they've got very much higher margin, profit margin, than they have over here. So that would be something that managers would need to worry about. What has changed? How come their pricing or their costs or their product mix has almost halved to what it was 10 years ago. You'll also see they're much less efficient. They used to have net asset turnover ratios here 15, 16, 20 times. Now they're half that. What's wrong? Why aren't they getting stuff through the store? And this ratio here usually goes the opposite way. When you're doing well, as they were back here, you don't need to borrow money. You've got surplus cash, and you can see here they've got very low levels of gearing. But over here, they've got much higher levels of gearing because they're less efficient. They're not making as much money. So these are good ways to get a good glimpse at what's happening in a particular company. Track the ROE and then its three main components over time. Of course, shareholders are also going to want to look at the share price. And you can see for the same company over here, the price improvement over the last 10 years has been about 10% per annum. That's very poor. You could add the dividend to that, which would take you maybe up to 13 or 14% for this company, but that's poor. Their competitors have done very much better than that over 10 years. So the ROE is bad, and so is the share price, the share return to investors. So these are just neat ways of looking at the company. Now, this method that we are using where we say, let's start with ROE because it's a really good metric, was first put out by the DuPont chemical company, and they used this to measure all their divisions. I like it, and I think it's a really good way of understanding how to break up and look at ratios in companies. You start with ROE, and then you break it down into its three main components: its profitability, its efficiency or activity or sweating assets, whatever you want to call this one, and its gearing. This ratio focuses on the income statement. The activity ratio first focuses on the asset side of the balance sheet. Are you sweating those assets? And this ratio here focuses on the financing side of the balance sheet. And you can then take this and drill down even further. Here's our ROE. If we've got problems with our profit margin, it must be because of pricing or costs or mix. If it relates to our efficiency, well, is it our fixed assets or our working capital? And we can look at all of these sets of ratios here. Or is this a problem related to our financial structure, our capital structure? In which case, we must have a look at this. I hope you found this useful and that you will start to think more carefully about these metrics and the importance of ROE from accounting terms and returns to shareholders from the other side.